Welcome to the world of indicators. Warren Alcon here to guide you through the second block of the Uncrypted Crypto trading course. In this video, you'll start to learn what indicators are, how they work, and how we use them to our advantage to set stronger trades and hit bigger gains. Today, it's all about moving averages. Let's get started. Moving averages are one of the most common indicators used in technical analysis. Simply put, they're formed by taking the average price of an asset over a specified period of time and then representing that price as a single line flowing horizontally on a chart. There are two different types of moving averages that we're going to be going over in this video. The first is a simple moving average, or SMA. The next will be the exponential moving average, or the EMA. These indicators can be used to help us gain insight into price action history, especially when used with confluence and on multiple time frames. So we're going to start with a simple moving average, or the SMA. It's calculated by a set of closing prices that are added together and then divided by the number of prices in that set. This value gives you the overall average price. If you're a math geek, here's the equation pick. The SMA is commonly used to track averages for long-term trading, using the weekly time frame and higher. It's used this way because the equation only factors in median average price over the specified time frame. Because of that, it can be slow to react to rapid price fluctuations. Another setback the SMA has, its inputs rely heavily on old data. When calculating, it factors the old information, like the 200-day, in the same way as the most current time period. And with the volatility of the crypto market, the SMA might be too inefficient at reflecting rapid price market movements, which is why I really don't use it, not even really on the weekly time frame. So, on to the one that I do use. It's the exponential moving average, or EMA. So the EMA is similar to the SMA in its function, but its calculation puts greater value into the most recent data points, which gives us an indicator more sensitive to price action, so it reacts faster than the SMA to rapid price swings. And for that reason, the EMA is usually the preferred moving average for most traders. All right, let's get your MA set up in TradingView. So get your desktop utility up and get ready. Go to the top toolbar and click on the Indicators tab. Type in Exponential Moving Averages. And from the selection list, you'll see your available options. To the left of the indicator, you'll see a star that you can select. Clicking this is going to add it to your favorites list. So go ahead and click the star on Exponential Moving Averages made by Merck15. There we go. It's added to your list and to your chart. Now in the top left corner of your chart, you can see your new indicator tab. Now I prefer this EMA indicator because it gives you 4 different lines of information to configure instead of just one. This is going to help you out because the free version of TradingView only lets you use 3 indicators at one time. So this is going to save you some time and frustration. So up here, let's go through the basics in the top left. EMA S9 close 20, this right here, this small arrow underneath is used to collapse and expand your list of active indicators. When you hover over your indicator, this is where you can edit the settings. The first icon, you can make your indicator visible or hidden for a quick cleanup. Next is the settings wheel. Click on that. Okay, let's get set up. Start off on the Inputs tab. Here you can see the 4 EMAs that you can configure. For 1 and 2, I set those up for 12 and 28. For 3 and 4, I keep those at 50 and 200. Keep your sources at close. Now let's go to the Style tab. Here is where you can choose which lines are visible by checking these boxes. And here you can manage the color, opacity, and weight of your trend line. In this box here, you can change how the EMA is visually represented on your chart. I keep it simple and clean, so I just stay with the line setting. Under Outputs with Precision, this default setting is going to show the price per line in a standard 2-digit currency format from 0 to 99 cents. So you can select up to 8 fractions if you want for lower price assets. Labels on Price scale are highlighted on the right-hand column over here, and values on status line are shown up here. I usually keep them hidden to keep my charts clean. Down here, you can reset the settings or set what you have as a default. So let's just make the setup our default for now. All right, real quick, let's just hide EMAs 1 and 2. And this is what your chart should look like. If you're all set up and ready, let's get into it. So we're basically familiar with moving averages, how they're calculated, and what the simple differences are. Let's go over a few base points that they all share. They're used as a visual representation of an asset's price. This line you see is going to change its position based off of direct inputs that you've decided. They can be used individually, in pairs, trios, or in large groups. When used in combinations, these lines can interact with each other. And based off their relative positions, we can make assumptions on future price movements. The first way is using a combination of moving averages. One popular combo is the 50-200 for long-term trading and higher time frames like the daily and weekly. So if the 50-day moves below the 200-day, it's a confirmation of a bearish momentum. If the 50-day moves above the 200-day, it can be seen as a bullish confirmation. As you can see, it's not really the best method to use because by the time the crossover happens, price has already had a significant move to the up or downside. So the second way is to see where price is in relation to these lines. If price is above the lines, the trend can be seen as bullish. If price drops below your trend line, it can be seen as a bearish movement. So using this method helps us keep pace with trend direction. The third way is to use moving averages as areas of dynamic support and resistance. So you can see how price does react to these areas just like support and resistance and also trend lines. So here on the BTC daily time frame, price fell below the 50-day moving average, giving us a bearish momentum signal for a possible short position entry. Price action is testing the 50-day as an area of resistance. Price is also rejecting our static resistance level, which also lines up with a recent swing low neckline. There's long upper wicks, shrinking candles, and a candle color change. We check back on the weekly to confirm the downtrend, and so far, this is textbook confluence. Let's go into our moving average settings and switch over to the 1228 and hide the 5200. Now let's look into the hourly time frame and hide this temporary neckline and zoom into this area. So the first thing I see is a consolidation channel. Now we can finish drawing it out by using the swing high as a reference point. And right here, you can see the 12-day moving average fell below the 28-day, which is our bearish signal. We can also have bearish momentum with these lower highs and these lower lows. And as you can see, price failed to break to the upside after a quick retracement. Price also fell below this area of support in the consolidation channel. So far, we have bearish confirmation on the weekly, daily, and now the hourly. Based off of our confluence and indicator relation to price, we're confident to enter a short position. How long the downtrend will continue, it's going to depend on social and economic variables, such as the BTC ETF sell-off that's expected to hit soon. So we'll keep an eye on price action on multiple time frames to look for any trend reversal indicators so that we can pull out of our short position and get ready for a long. And also keep in mind that price action on the weekly, it's still above our moving averages. The 50 is still above the 200, so there's still some bullish momentum present. So before we move on, how you liking the channel? Please ask questions, comment below, hit the like, comment, subscribe, and share buttons to help support the channel, because I'm still just a one-man show here. You know, when we get into trading styles like scalping, day swing, and investment or position trading, we'll go further into depth on using moving averages for each time frame in a later video. But until then, here's some basics. For scalping, you're going to be in the intra-hour time frame, and your EMA is going to be a 5, 8, and the 13. For day trading, you'll be on the 1 hour, 4 hour time frame, Around there, your EMA will be at 12.28. For swing trading, you're going to be on the daily time frame, and you're going to use an EMA of 2050 and the 5200. For investment or position trading, you're going to be on the weekly and above, and you're going to set that EMA to 17 and 43. So as you can probably now understand, different time frames require different methodologies. This is why in the beginning of this course, we focus so much on getting comfortable in charting price action on multiple time frames. Now, if you have to go back and get more practice in, go for it, do it. Take your time and make sure the basic theories are crystal clear, because it's only going to get a little more difficult from here on out. So when initially getting familiar with moving averages, one question that comes up early is, why do moving average lines change position when I view them on different time frames? So the reason being of that is that the calculations used in moving averages, it takes each candle into consideration. So the more candles, the more variables that need to be factored in. And really important, you don't need to overthink about the math involved with how indicators are calculated. Just focus on how they function and how they translate onto the page. So, with all that said, here's some homework for you. So this is going to be a heavy load. On each of your tickers, apply the 1228 and the 5200 for right now. And on each asset, take notes of where price action is in relation to these lines. Above for bullish, below for bearish, or is it nearing a break? Then see where the lines are in relationship to each other. Is a 50-day above or below the 200? Check to see if the moving averages are acting as any form of dynamic support and resistance. Then you're going to see if price action is nearing any areas of confluence, and see what signals you're getting from our checklist so far. Static and dynamic support and resistance, chart patterns, candlestick patterns, candlesticks, moving averages, and they're all checked out on multiple time frames. So from what you've learned so far, where do you think price is going to go with each of your tickers? Remember, confirm our predictions based off of price action and chart patterns. We only use indicators to reinforce our predictions. Have fun. As always, take notes, and we're going to see you in the next video where we'll be covering Bollinger Bands. Take it easy.